So yeah, if you right now, if you don't evolve, you will die in this business because the next generation of home buyers is just absolutely changing the game.
What's up, guys? Welcome to another episode of Invest Iowa. Today, I have Jared with me, and we're going to talk about, he's a loan officer. It's been playing on the game for quite a while, and now we're going to talk about your common questions, rates, where we at, future generations, what's to come, how do we see that picture, especially here in the Midwest. Thank you for coming, Jared.
Hey, thanks for having me.
Man, so let's get started with kind of like your background. How do you become a loan officer, and how's been that process?
Yeah, so I graduated college in 2019. I played basketball in college for 4 years, and then after school, my academic advisor was like, "Hey, if you want a job, get this degree." So I was like, "Screw it, this is just what I'm gonna do." So I got a job in IT right out of college. Did that for a year, and then I met my mentor through mutual connections in 2020. So then I made the switch down to Des Moines in 2020, and been doing mortgage originations ever since. So it's been quite the journey. Obviously, I don't even know what a normal looks like because 2020 was madness and 2023 has just been, or through 2022 and 2023 have just been a different, market lull that we haven't seen in a long time.
I see what you're saying. What's that change? Is it slowing down? Is it the same? What are you
Yeah.
seeing?
So I think compared to 2020 and 2021, like it's slow compared to those times. I think from a average, it's still probably pretty high in terms of total volume that's being done. But like mortgage applications year over year are down like 40%. And the reason that being is I think interest rates have played a big part of that. And I don't think, obviously being rates that have touched the sevens, but have been sitting pretty consistently in the sixes for the last little while. um, that's it scares a lot of people, and rightfully so, because when home prices go up and interest rates go up, that creates unaffordability. So, we've seen quite a bit of a slowdown. I mean, it's not as slow as like, I mean, some people are really slow, but there's still movement in the market because there's very, very low inventory. So we're in this weird little world right now where there's people who can't afford to buy because interest rates and home prices, but there's a ton of people who want to buy um, because there's just not a lot of inventory, so things are still moving.
What do you see the banking industry doing to kind of like play this game?
Yeah, well, and I'm sure you've seen these bank failures that have happened. Um, I think it's very possible that we see more of that, because there are when the Fed raises their interest rates, that affects your credit cards, that affects your car loans, your personal loans, stuff like that. Well, some of these banks are getting a lot more conservative with their lending because they don't have the liquidity that they had in 2020 and 2021. So with that being said, it's made it more difficult to get a loan as well. Underwriters have really, cracked down on some loans that you maybe thought could get done in 2020 and 2021. Um, but also there's also been some creative financing that has come out of with like different loan products to allow people to still get them into homes. Like one product in particular is a 2-1 buy down, which is like a temporary buy down. So you've probably heard people say like you can buy discount points to buy down your rate. But in a high interest rate environment, that doesn't really make a lot of sense. So a temporary buy down, like a 2-1 buy down, just means that for the first year, your interest rate's 2% lower than the market rate. And in year two, it's 1% lower than market rate. And then year 3 through 30, it goes to that market rate. So the thought is you can hopefully refinance during that first 2 to 3 years. That way you can recoup some of that money, and you didn't have to drop a ton of money to buy down a permanent rate just to lose all that.
Right. And this type of strategies, who are these strategies meant for? Your typical single family homeowner?
Yeah, yeah, definitely single family. The nice thing, a lot of first time home buyers is who I've utilized it for, because
Okay.
generally first time home buyers are the most sensitive in terms of payment, and rightfully so, right? They're not making the maximum amount of money that they'll make in their lifetime. So they want to keep their housing payment down. So this is a strategy that's really helped a lot of people where yeah, if it gets to year 3 through 30 and rates have never come down, well, then you look like the hero because you locked that in, but also your rate's 2% lower in year one. So I mean, it's hard to beat that.
Okay, so in comparison to the last couple of years where the demand was just higher and there was more inventory, right? Were you seeing how are the denials playing a role into what we're seeing in this current market? Do we see more denials now or more denials back then?
I think right now, I've seen a lot of scenarios where there was some loans that that were, like you said, you would think they would have been able to get done 2 years ago, but now you get a phone call and like, hey, this place isn't able to get it done. Can you take a look at it? And I think, and really a lot of it comes down to just, the type of underwriting, because how mortgages work is mortgages get sold into the secondary market, meaning that there's investors who buy these mortgages and, you can buy mortgage bonds. That's how they get packaged up. So Fannie Mae and Freddie Mac are the institutions that make these rules and buy these loans. So, if I do a loan and our company tries to sell it to Fannie Mae, Freddie Mac, and they're like, "Hey, you didn't follow the rules here," well, then we have to buy that loan back, and it goes against the money that we lended originally, and that makes our rates higher. If you do it, if you do enough bad loans, it's going to make your rates worse. So nobody wants that, especially right now when it's already tough to get deals. So, that's
So
where things are.
pause for a second. So you
Yeah,
said that if you don't follow the guides of Fannie Mae and right, does that mean that they won't take the loan? Who assumes the loan now? Do you guys have to buy the loan?
correct. Yep.
So
So how it works
technically,
is,
keeping it in house is that?
yeah, so in-house, so like a bank or a credit union, they can take loans in-house because they have deposits, right? So you have a checking account with a bank, that money that gets lended out for different types of things. So if they have a loan that they want to keep on their books, they can do that probably easily depending on what their liquidity looks like. Where we don't have deposits. We're just a mortgage company, and this is how many mortgage companies around the nation operate. We don't have like in-house financing generally.
I see what you're saying.
So this is the one where, yeah, if we try to sell that loan off, we didn't follow the guidelines. We have like different call 'em, lenders that give us a warehouse line of credit that we can lend off of. And if we have to buy that loan, that goes towards our warehouse line of credit. And if you do enough of those, then that's going to impact your rates on that because you can't lend as much as you would have been able to before.
Hmm.
It's very complex.
Is there any cases where where a mortgage company runs out of, goes out of business because of it?
I mean, yeah, that's kind of, I mean, there's been a lot of mortgage companies that have already shut down because they're slow. So that's like margin compression in with mortgage companies right now has just been a real thing because um, when you have to compete on rate already, along with, maybe you aren't doing haven't but you were doing loans that you probably shouldn't have been doing, all that combination can absolutely crush your profitability and you'll see places shut down.
Yeah. Is there FHA, conventional, VA, USDA? Those are
Yep.
your four typical loans. Is there any else that that you got on the books worth taking
Yeah.
a look at?
Yeah, so those are going to be your most common ones that you'll see. But then we also have brokers that we work with that'll do non-QM loans, is what they're called. So like non-traditional types of loans. So like physician loans is a big one, where those like loans specifically for like doctors or something like that. Um, Bank statement loans. So this is where you really get into the investor piece because you have, I'll say like the two big ones that you'll see is a bank statement loan. So someone who's self-employed, they will, sometimes they don't have the money on their tax returns to show a bunch of income, but they might be able to show the deposits on their bank statements. Um, so that's a non-traditional form of lending, but also another one is a DSCR loan, which is debt service coverage ratio, where basically as long as the rent covers the payment, the loan can be generally be done. There's different stipulations. That's a very simplified way to look at it, but that's the most common investor loan that's non-traditional.
I see what you're saying. That's it has to cover 1.25,
You-
is it?
It depends on the broker. So
Depends.
that's the thing where Fannie
Okay.
Mae, Freddie Mac, it's like very black and white. Where it really like one broker might just say one per one. Some might say 1.25, one might say 1.5. It just depends on their
Okay.
appetite for that
And
loan.
do you consider those loans a residential loan, or you start to dabble into what will be considered commercial loan?
It would still be deemed residential, 1 to 4 units.
Okay.
Um, so anything above 4 units is going to be a commercial loan generally.
Right.
Yep.
Generally, is there any cases where a triplex will be considered a commercial loan with a blanket maybe on a multiple properties?
It would just depend. It really just depends on the broker or the person because those non-traditional options, that's going to be in-house money for a bank
Mm,
or a credit union. So they're they have their own rules, and sometimes they might just say, "Heck, we'll just take this and give you residential terms." So it really just depends on the place. I don't have one off the top of my head that I could give an example on though.
no, I see what you're saying. No, it just depends. It just varies from broker
Right.
to broker.
Yeah. So
Right.
and you get their sheets and they tell you, but then obviously you call their account executive and say, I have this scenario. What do you think? That's the nice thing about brokers with that is the account executives are commission as well, so they want to be able to do loans too. Um, so they have their stipulations already, but if there's wiggle room, they want to try to get them done too.
Right. From your opinion, what's to come? Like I know that nobody can predict the future. Rates, as we currently speaking, they're on the high sixes that you said,
Yeah, I think they're probably, in the sixes for sure. High sixes is kind of like the national average right now.
right? As
And
we speak, right?
as we speak, right?
But
Yeah.
but what
S-
what, what do you think is going to happen? Like
Yeah.
just merely from your opinion,
Yeah. I think what's going to happen is right now mortgage rates are really tied to inflation. They're really tied to essentially let's just be real, a recession. Usually when there's a recession, interest rates go down. All indications show that there's a recession that's coming if it's not here already. So I think rates are going to come down. I couldn't tell you the exact timeline, but I think what's realistic is, in the fives by the end of the year. Um, and it's really, obviously inflation's been trending down for, I think 8 straight months or something like that. Um, but then we have to show that unemployment's getting worse,
unemployment.
right? Which sounds bad to say, but it's better for interest rates when unemployment's getting worse.
It's a
So
trade-off.
yeah, right, exactly. So, and let's in historically fives to sevens interest rates are pretty normal. So anything below that, like we saw in with during COVID, like 2.2% rates, like aren't that means there's something wrong with the macro economy, obviously. And there was COVID and people lost jobs and honestly it felt like the world came to a standstill for a little while. So but I do think we'll see fives, by probably by the end of the year.
And with so according to that, maybe five will bring kind of like a bigger rush into people trying to refinance and just kind of like the economy overall, just getting the ball rolling at a
Yeah.
faster pace, right?
Yeah, I mean, when there are recessions and like economic slowdowns, like even like during COVID, it's a perfect example. Like the housing market is what has pushed the economy through tough times. Obviously, 2008 was different because that was the reason of the economic crash, but housing is generally strong through recessions. So you'll see people refinance, save money on their housing payments, buy new houses, but then it's then we might enter a world where we were in 2021 where there's such low inventory that when rates go down, you're going to get a new flood of home buyers that that may not be good for the housing market too, where people are going so much over asking and stuff like that. So it really, I mean, there's trade-offs to it, right? But also, I think having rates come a little bit lower is going to be better for the average home buyer.
Yeah, that's. I think eventually, I was just having a conversation with a buddy of mine. He's Canadian, and he's
Yeah.
he's he's working with different strategies over there on like
Yeah.
commercial loans. They're looking at a 50-year amortization on some commercial loans, right? That,
Yeah.
of course, there's some regulations, and Canada has plenty of those. But do you think 40-year amortization, maybe even 35, is that even in the conversations with the Fed or the banking industry?
Good question. So FHA does allow 40-year mortgages on modifications. I think there are some special requirements in order to do that. Like you have to be behind on your mortgage and stuff like that. And I think at one point there were 40-year mortgages when the housing market crashed. I don't think it's out of the realm of possibility. But there's a trade-off, right? Like if you're only going to stay in a house for a couple of years, then a 40-year mortgage probably doesn't make sense because it's already like interest is front loaded on your mortgage. So if you're not going to be in a house for very long, just know that like you could get stuck with very little equity trying to sell and you're not able to. So that could be a negative of a 40-year, but obviously if it's a forever home, I don't see a problem with it.
Okay, you could get stuck with it. What
Yeah.
about for a rental?
Did the no and that's where, did the numbers make sense, right? Like there's more. I mean, finances is a big part of how making numbers work. But do you think? I mean, let me ask you this: if would you do a 40-year mortgage or a 40-year loan if it made the numbers work?
100%. Money today is worth more than money tomorrow. So
Right,
all day, just put a tenant in and just rent it out, and increase rates every single year.
right. And that's the way I would look at it. Like if it makes sense and it fits your goals, let's make it happen.
Hmm. But you don't see that those conversations are not happening yet. You don't think?
No, I mean the media came out and told everyone that 40-year mortgages was coming, but they totally misrepresented what was actually happening. That was that FHA was allowing 40-year modifications, but that's
Yeah.
only if you already have an FHA loan. That's not for any new loans.
Hmm. When do you think this is completely changing topics? But
Yeah.
when do you think mortgage companies, and just like banks and credit unions overall are gonna start uh considering SDR income as a way to back up a loan, short-term rentals?
I mean,
It's
there's an element that you can use it already. So if you're buying an investment property, so this is maybe a little technical, but if you're with the guidelines, but
hit me with it.
if you're buying an investment property, you can use projected rent in order to qualify for a house to offset that payment. And same with tax returns. If you've already received short-term rental income on it, then yeah, you can use, there's calculation to figure out what that number is. Is your question more so for like collateralization or is it more so just like using that income?
Both, I guess. I mean, I guess my perspective is I don't think banks are necessarily like looking forward to using the short-term rental income as a part to offset kind of like a DSCR loan, but with the
Mhm.
short-term rental. I don't think they're looking forward to it. So I just wanted to get your opinion on what
Yeah.
they think.
Yeah. No, I mean, I don't think I think Fannie Mae and Freddie Mac at least know that it's a real thing. Um, but I guess here's the one. So you can buy a second home and put 10% down. And you can use that second home, like as long as you're planning on living in it for a certain amount of time, you can deem it as a second home and still use income for it or like get income, short-term rentals. Um, but you're not able to use that income to qualify. But if you ran it as an investment property, you can use projected rent income to qualify. So like I think that piece hasn't been addressed. I think I don't know what that looks like in terms of getting short-term rentals income for a second home to help offset that payment. But it's also tough to prove that someone's gonna, you know, say that they're gonna use it for an Airbnb on a second home if they plan on actually spending a lot of time there. So where an investment property is truly like, hey, we don't plan to live in this. We're just totally using this as income producing, if
Hmm.
that makes sense.
Yeah, no,
I know it's
that
probably
makes
not a
sense.
good answer for you, but
No,
that one is
but
a very tough one to address.
Yeah, I mean, I wasn't expecting you to give me the answer and the solution to all the U.S. crisis, but I definitely just wanted to get your insight into it. Um, and now, kind of like with the loans that you're working on, are you more on the investor side or more on the your retail customer, just your retail home buyer, first time home buyer, or just like anybody in general that is not in real estate?
Yeah, I mean, given my age, a lot of the demographic that I end up working with is first time home buyers and move up buyers,
Mm,
um, which is kind of leading to where the next generation of home buyer is going. Where millennials, I think, are or boomers right now are the number one home buyer right now because they have the most money, and like you're seeing a lot of cash deals are the ones that are able to make that happen. But eventually, that generation's not going to be buying homes as frequent. And so millennials are out like the number two big home buyer right now because that's when you're in your 30s, early 40s home buyer right now. And the average home buyer, first time home buyer is 33 years old. But
yeah.
the next generation of home buyer is your Gen X, or I'm sorry, Gen Z. Um, and these are people who are essentially 25, 26 and younger. I don't know how old you are, but I'm 26 and I guess I'm considered Gen Z. I don't know how, but um but 25-year-old Gen Zers have the highest home ownership rate than any generation did at the same age at 30%. If you're
What do you?
25 years old and you're a Gen Z, 30% of those people own homes, which is the highest percentage in history.
Well, why do you think that is?
Well, I mean, I think, if you want me to be very honest, I think it's a FOMO thing. Like, I think there is this with the growth of social media, owning a home is cool, and I think there's a big view on that. And if people are able to do it, like Gen Z is very much like, hey, I lived with my parents to save up money to pay off debt to allow me to buy a home. I've seen a lot of that where the past generations it wasn't like that. You're out, start having kids really early, or you're married young, or you're just out on your own. Where now it's a little bit different demographic where they're out saving money at in different ways than what past generations have, and allowed them to buy homes. Um, to go along with that, how they try to find who they're going to work with and how they get their information is different too. I think like almost 50% of Gen Z use social media to find who they're going to work with and find info on homes. Which is just completely
Wow.
different. Yeah, it's
See,
it's massive.
I'm telling you guys, social media is the new newspaper, the new advertisement, the new Super Bowl advertisement. Like social media is now capitalizing what you consider marketing.
Yeah,
That's
it's
insane.
it's changing the game. And my business coach, he tells us you either evolve or you die in this world where I know loan officers who get the majority of their business off social media because they've created a system to bring in leads. Um, and I think, I mean, that's where the next generation of home buyer is. So there's going to be some people who just never adjust and adapt, and they're going to lose in that world.
Okay, maybe this will be some great advice for older generations, and I know a lot of them are probably not going to be on these social platforms, but what are you doing in terms of networking that you don't see the older generation that you think they should be doing?
In terms of networking,
In terms of like how you managing your social media
yeah.
to drive that business in the same way that they do without it.
Yeah, I mean, I think it all comes to exposure. I use my social media to really like cast the widest net as I can. So creating content consistently, but also I built a platform where I'm doing live events to get in front of these agents who want to learn. Because there's another thing too is like there's just not enough good information for realtors to learn from each other. I was talking to a group of agents the other day who was like, our brokerage does these classes, but they don't have the right people to teach them, so I just never go. So I
Mm,
see it on me to, okay, let me talk. If you want this person on there, let me get in front of this person and teach a class with them and let you be there and learn from them and set this whole thing up for you. So that's the way that I approach my social media, and where, you know, a lot of, older generations, but even in our generation too, a lot of people get their business from referrals. That's never going to go away. And I think the best way to get referrals is build out a client experience that's, you know, that is worth raving about. We want raving fans. So Google reviews, word of mouth marketing, those are going to be your two biggest things if you're not on social media.
Wow. Yeah, that's I think from there, the biggest thing, my main takeaway of like Instagram, social media in general, is that uh you have now access to knock on the door to every single person that you see on social media. It's like if you walk into an office of somebody you really like and you get to knock on the door by just sending a text. You don't know if they're gonna open, but would have you had that chance without social media? Probably not. Where
Mm-mm.
where will those famous people that you want to learn from be? Let's say Florida, let's say California, let's say out of the country. How do you get to be in front of those people? And social media is allowing you to do that. Whether they reply to you, well, that's up to you, because a lot
Right.
of cases they won't value. But
Yeah.
right now, social media is allowing you, you can knock on these people's doors,
Yeah.
see if they answer. And when
Yeah.
they do answer, your life changes for the better.
Right. Well, and this, I mean, just a platform that you're doing, right? Like, how many people have you got on this podcast due to social media? And
Yeah.
and you've got a lot of big names that have come on here, and provided just great content that now you're sharing. And now, if you want a new interview or you're talking to somebody, you have validity yourself when you can be like, "Hey, I already talked to this person. And we had a great conversation." So, social media also gives you validity too, I think, especially when you're giving out great content.
Yeah, and I know a lot of people that are just like, well, excuse me for the language, so they're full of shit, because you see their social media, they're not doing really as much as, but like you get to find out real quick when you get in conversations with them if they're about it or if they're just trying to fake something. But
Hmm.
for the most part, most people are trying to add value to each other. But the
Yeah.
amount of business that comes from social media, it's insane.
Right.
Everybody has something that they can add value to you. They, in one way or another, they can always add value to you, and you can always add value to them. All you gotta do is knock on the door.
Right. And I think what the two biggest complaints, and I'd be curious to know if you agree, the two biggest complaints that I get when I talk to people who choose not to is they don't know what to talk about or like what topic to do, and they don't know how to edit or they don't want to edit. Um, and I think, the solution to that is, for me, I go on and I find ideas from what other top media content creating loan officers are doing. Like, a lot of people have set the playbook. You don't need to recreate the wheel. Just find something. If you're comfortable talking about it, then that's when you can create it, make it your own. I mean, maybe don't copy it word for word, but you can definitely take it and run with it. And then I've totally outsourced my editing at this point because it's my time is more efficient than trying to spend 1 to 2 hours editing a video, and it's not even going to look good when I can just pay somebody to do it for me, and it's going to look way better. And I probably could spend that time going making phone calls, calling agents, calling past clients, stuff like that.
I see what you're saying. Yeah, no, I totally agree with that, because it's the power. If it was easy, everybody will do it, right? Like at some point, like the older generation, in my perspective, they had something hard that they had to do, right? Put
Mhm.
themselves out there, because the only impression that you could make is when you met the person, right? Now with social media platforms, you get the advantage of creating an image for yourself. So when they reach out to you, if they want to know about you, they can figure out everything you want them to know about you beforehand for them to decide whether they want to reach out to you or not. Which in the older generation, you couldn't, because you just had like shake hands, nice to meet you. Did you start a good conversation? Did the person get interested in the first 3 words that you said to them? No. Okay, that was the only chance that you will get, and you won't see that person ever again, right? Whereas social
Right.
media allows you to do the opposite.
Yeah. And actually, I'm glad you make that point. So my coach, he looks at it as a funnel. So if you look at the top of the funnel, that's where you're casting a wide net, where you're doing social media, whatever it is, what podcasting is another one. And you just got to work yourself down the funnel where these people who are going to reach out to you, or even you reach out to them, where it's like, okay, you got them on social media, you've been hitting them with content. Okay, now you get them to maybe an ebook, or you take them to bring them, have them come on to a class. and then they join that, and then you reach out to them to set up a one-on-one meeting. Like, you have to work your way down and let business come to you, rather than, the old school way is you pick up the phone, you call 100 people. And like you said, if you don't make that impression in 3 seconds, you might have just wasted your time. Where if you create the impression, you're going to attract the people that want to be around you.
Yeah, that's 100%. That is exactly what you and I think are doing on social media, and not like we're the best at it, but trying, I think, puts you on the 1% that is actually doing it, and against the other 95 that I don't think are doing it. Like, I don't think
Yeah.
that many people are actually taking action.
Right. Well, and
Yeah.
I think let's be real. I think the quickest way to get a deal, or in a scenario, is you do pick up the phone. Like, that is the quickest way to do it, but it's just
Yeah.
way more labor intensive. Social media is a long game, but if you're consistent and you can stick with it long term, you look at Gary Vee. That's not something he did in 2 years. He's been doing social media, I think, since the inception of social media, and now look
Right.
at
I
what he's turned into.
Yeah, 100%. He's turning into a goat of like social media in general.
Yeah,
But
dude, it's next level.
and then when I think about my podcast, what's my ROI on my podcast, right? I have no idea. But the amount of business that I have generated through making connections with the podcast, I
Yeah.
think has already paid me everything that I have ever done before. And that is just to prove that, like, and how do you, like, if you were to pitch this to an investor, right? How do you tell them, like, hey, if you start a podcast, you might make more money than you have ever made, right? How do you say that? Like, you don't know. Because when you start a podcast, you don't know what you're getting into, but it's just that high risk, high reward, I guess.
Right. And you build, it's the attract thing, right? Like, you have built this podcast. Who I was in the weight room and I was talking to somebody about it. Like, just offhand, it just got brought up. But like, that's the type of impact that you've had with your podcast so far.
That's good. You want people to talk about you without like it's the more people you talk to, the more business you get in general. I just truly believe it, and I hope it's working, and I'm glad that's working, and I'm glad that I'm reaching the right people like you or Louis or like everybody that I've had on the podcast that are the people that I want to surround myself with.
Right.
Yeah.
No, I think social media is the future, especially in the housing industry, like Gen Z. That's the next generation of home buyer. It's no secret how they are looking for who to work with and the type of houses they want to buy and stuff like that. It's just a matter of capturing that, and that's the hard part, right? Is being consistent enough to capture all of that.
Being consistent. Key. Hey, man, this has been amazing. How do people contact you if they have more information? They want to know more about you. They overall want to get connected with you.
Yeah. So if you want to go on my social media, great way to do it. JN_mortgage. You'll be able to find me on there. If you want to reach out to me, shoot me a DM on there. If you want to call me, shoot me a text, 641-330-2932. And I'm available anytime.
Cool, man. That was a lot of information. I always like to that the lending world always changes. It's not like you can interview one lender and then like mortgages haven't changed at all. Like, there's always something going on. So there's always something to talk about. And I'm glad I had this conversation about the future generation. I feel like it's important. And it makes me realize who am I actually targeting on the long term. You just opened my eyes. So I appreciate it.
No, thank you for having me, dude. I'm sure we'll do this again in the future.
Absolutely. Man, if you guys made it this far, please subscribe and hit the like button. It helps everybody that is involved in this. And I'll see you guys in the next one.